Alright everyone, Cowboy Trades here, welcome back to the channel. It is now officially the first trading day for 2023. The stock market has just opened and it is not looking good. As you can see, coming over to the E-mini futures, this was the first candle we had since the 30th of December, and on the daily time frame, we kind of spawned all the way up here, 3,900, poked our head above the top of this diamond bottom formation we've been talking about for a little while, and we absolutely started nuking to the downside. At this moment in time, the S&P 500 is down approximately 0.8%, 0.7% on the E-mini futures. So basically it's almost down 1% on its first trading day of 2023, which is not a good look for the markets. Now, I don't really look at the 1 hour time frame. It looks like, you know, we're making lower lows and lower highs. We've bounced from the bottom of the support line over on here, and I don't quite think we're ready to break through the floorboards of this, mainly because we have a very, very important FOMC minutes, which will be taking place tomorrow at 7 p.m. GMT time. And I'll make a separate video about my thoughts on the FOMC minutes, but for right now, we're still in this same range for the E-mini futures, and this pattern is not looking good whatsoever. It really looks like we're going to start breaking back down to the downside. Now, considering I think that we should be breaking down to the downside, let's go check the liquidity conditions for the E-mini futures and the S&P 500 and see, you know, does liquidity agree with me on this? Is liquidity overextended at this moment in time? And yes, it is. Just like we talked about in our previous video, you can see a lot of the time where liquidity tops out, and this is, by the way, these blue lines where the liquidity tops out is always areas where the S&P 500 also tops out. If you're a veteran of the channel, you'll know that we've looked at that chart many times, but you can see breakdowns happen, buybacks happen, and then a final meltdown happens. Then you can see overextension in liquidity, breakdowns happen, a buyback happens, and then you have that final melt back down to the downside. You can see over here, top in liquidity, break back down, buy back to the upside, and then you break down and make new lows. And over here you can see overextension of liquidity, which marked the top in the S&P 500. We've broken to the downside. And in the immediate short term, if I come over to like a shorter time frame, looking at what's happened in the past month, you can see that once again, we've seen this buyback. The mid price has started to roll back down, but a lot of these contract sizes have started to spike up, and we have seen a relatively decent spike in the past, you know, month or so, as the S&P 500 has started to break back down to the downside. So liquidity conditions definitely support my thesis that we should be breaking back down to the downside of the S&P 500. What are my price targets? My price targets are unchanged if you've been watching me for a while. In fact, the price action has really not changed since my last video. You can see the last time I drew this out, I talked about a few different things. I talked about overextensions of liquidity, overextensions in basically everything. You can also see this bearish pennant breakdown. We had a double top formation over here running into this macro trend line since we topped out for the S&P. And, you know, with this breakdown, I do think we're coming all the way down to fill this bearish pennant price target at 3,215. In the immediate short term, of course, though, there is a price gap down here that we do need to fill at 3,607. So in the immediate short term, of course, this will take a little while. I don't think we'll be here tomorrow. I think this will probably be, you know, a week or two away from now, maybe less, maybe 5 days. It really depends on how bearish the FOMC minutes are tomorrow. And of course, I will keep you up to date on that on the channel. I will be making a video about that tomorrow, and I'll post my thoughts over on Twitter when it does happen. But you can see in the immediate short term, I would be predicting about a 5.3% break to the downside for the S&P 500. Now, in terms of rates are looking pretty healthy right now. I mean, we can start off on the DXY. DXY hasn't done too much. Of course, the DXY isn't a rate, but when we do come over, you can see, like we've been talking about, at some point, I do think the S&P, the DXY is going to bounce on this trend line and start heading back up. We obviously can't celebrate too much while we're still making lower lows and lower highs. And in general, this year, I don't expect the DXY to do too much. I will make a separate video on all of my 2023 predictions. I've planned that out. I've written what I want to talk about. It will just be a little bit more edited and thought out than normal, so this one will take maybe a day or so, but maybe it'll come out later, we'll see. For right now, though, I do see the DXY in a very, very healthy position. I do see it being extremely oversold right now, and I do think a buyback is definitely going to take place. And even if that buyback doesn't take place, you can see other metrics which are more important. The TIP ETF is still breaking to the downside like we've been predicting. And if we do come over to The Nasdaq looks absolutely horrible right now and is really not too far away from breaking down into new lows. The SPY, basically the SPX in the first place, I mean, potato. This looks like a massive, nasty M pattern playing out. The QQQ for the Nasdaq, also disgustingly bearish, disgustingly bearish chart. The Dow Jones actually looks like it's got a inverse head and shoulders, which is bullish, although I don't believe the liquidity conditions will support a further uptrend for the Dow Jones. Now, the only other things that I really want to talk about are the rates, and I'm going to make a separate video about this. And of course, you can see the VIX. VIX starting off the year with a bang. We have pushed up 7.11%, bouncing off this trend line. And if we are looking at how the VIX is saying, you know, the S&P 500 should be moving for the next few months, if we do overlay these, you can see for the next month, the VIX is expecting an absolute melt up, which would be predicting a meltdown for the S&P. The VIX, if you're new to the channel, is the volatility index for the S&P 500, and you can see the VIX on the top, S&P 500 on the bottom. You can see VIX takes a spike, S&P 500 takes a break to the downside. VIX tops out, S&P 500 breaks down to the downside. So very powerful indicator, very powerful chart to keep your eyes on. The only other thing I want to talk about is government bonds, specifically for the US. I'll talk more about government bonds, you know, the Eurozone ones like Spain, Germany, Great British, Chinese, Japanese bonds. We'll be looking at these in a further video when I talk about my 2023 predictions, but the most important ones being the 2-year and the 10-year for the US government bonds. Now, starting off on the 10-year, you can see that this is quite recently broken out of this bullish pennant that we've been talking about. It's come up to the 0.5 and taken a small break back down to the downside. However, while this has happened, it's come back down into contact and tapped the daily EMA ribbons, while the daily EMA ribbons have flipped bullish. Now, if we come over to the 4-hour time frame, it doesn't particularly look like a bull flag to me or anything like that. It just looks like we're slowly chopping and grinding. We're finding support, we're breaking up, finding resistance, and then as you can see, we break down, and once we flip it, we back test it, push back up, make a higher high, come back down. And I do think, you know, whichever way you're looking at this, even on the 4-hour time frame, we're holding the EMA ribbons very nicely. On the daily time frame, we're holding the EMA ribbons very nicely, and I do continue to expect about another 20% increase for the 10-year yields this year, at least this year. You know, we could definitely push up a lot higher than this. However, let's take it one step at a time. I do think about another 20% increase is definitely underway for the US 10-year bonds, which is of course bearish for the S&P 500. Now, if we come over to the 2 years, you can see a very similar situation. We've kind of floated outside of this. There was multiple ways that you can draw this. Sorry for the yawn. I've been fasting for the past like 3 days or so, so I'm a little bit hungry, a little bit tired, as you may be able to tell. But nonetheless, you can see, you know, no matter which way you'll draw this, I'll keep this in the same position just in case we come back to this trend line. But we have broken to the upside of this bullish pennant for the 2-year yields. Basically the exact same analysis that I gave you in the previous chart. You know, we've broken out to the upside. We're making higher lows, higher highs, higher lows, higher highs. This was always bullish though. The 2-year, in terms of the EMA ribbons, has not been bearish since all the way. I have to scroll back so far. It hasn't been bearish since the 2nd of March 2021. You can see a lot of close calls where we broke to the downside, almost flipped bearish. Over here, you know, we broke into the short-term moving average. Here we touched the long-term moving average. Here we fell into the heart line. Here we fell beneath the long-term. Here we fell beneath the long-term. Here we fell beneath the long term, and here we fell beneath the long term. But just as these were tightening, getting ready for a big move, the decision was made. We took a huge run to the upside, and now we're once again back testing these EMA ribbons of support as they are pushing up bullish once again. So government bonds look extremely healthy to me. This doesn't necessarily mean at this moment in time the DXY will continue to push up too much further, and I will make an extensive video talking about why, even if the DXY has topped out, if government bonds keep on pushing up, especially being, you know, the 10 and the 2 years for the US, why this could still mark, you know, a very pivotal moment where the S&P 500 may not be ready to turn around. It may continue pushing to the downside, even if the DXY weakens. That might sound strange to you. However, wait for the video where I talk about my 2023 predictions, and I'll talk about why the DXY is very, very dependent on what happens with the rest of the government bonds, not only just with the US bonds at this moment in time, but how the growth of the DXY will be very, very dependent on what the rest of the economy does, what the rest of the countries in the world do with their interest rates. So this is going to be an interesting discussion. I do look forward to getting that out soon, but at least in the immediate short term, I wanted to give you an update on my thoughts on the S&P 500. I think we're very, very close to starting that next meltdown to the downside. And of course, I mean, on the weekly time frame, if we come over to something like the Heiken Archies, you can already see that we're melting down to the downside, but we're kind of finding a little bit of resistance, or rather we're finding a little bit of support here. And when we come down to the lower time frames, you can really see it's not looking like we're going to hold this floor for much longer. I personally don't think we're going to break down within 24 hours, but I do believe that we're going to break down. Whether that happens by the time I've uploaded this video, or if my prediction stays true, I believe the FOMC minutes will come out in like 24 hours or so, and then I think we're getting ready for that next major move back down for the S&P to the price targets, the price gap that I mentioned earlier on in this video. So all in all, S&P 500 looks pretty bad, and if you do watch my channel for my crypto content, you'll of course know that the S&P 500, the E-mini futures breaking down, DXY going up, government bonds increasing in strength, the TIP ETF breaking down, liquidity conditions topping out for the E-mini futures. These are all signs that are going to tie in with the fact that Bitcoin probably shouldn't be breaking to the upside of this bearish pennant. It will probably follow the S&P 500 and further break down to the price target that I mentioned in my previous video for my trade at 15,200. So Bitcoin looks bad, the S&P 500 looks bad. This is the first trading day of 2023, and we've started it off with a bang. Get ready for another brutal year. In my opinion, we're probably going to see another 3 to 6 months of pain in this markets before we see any sunshine. So all I've got for you for this video, my friends. As always, if you do enjoy the content, let me know down below by leaving a like and a comment. Share the videos with your friends. Also, if you want to come check me out over on Twitter, it is here at 618_cowboy. So all I've got for you for this video. As always, cowboy out. Peace.